Hello, I'm Tony Kaye. I'm the editor of Eureka Report, and we're talking ETFs today with Kris Walesby from ANZ ETFs. Welcome again, Kris.
Hello, Tony.
Kris, today I wanted to have a chat really about what investors need to consider when they're going into ETFs. There's so much money, as we've seen, coming into ETFs, but what are the things that people need to actually consider?
It's a great question. There's a lot of talk about ETFs. People are using ETFs more and more, and so then people they're trying to look at and see, is there any complications around it? And ETFs aren't that complicated at all. That's the key thing. They're meant to be simple. So there's just a couple of things I wanted to mention today, just for investors to consider. Firstly, on the technical side, the first thing is fees. So there's always a headline fee, management expense ratio, or a total expense ratio. But what investors should be looking at is to make sure that every fee is included, because some providers have other costs, and those costs are relevant to an investor and they're not always explicitly shown. So just to make sure that you know the total cost of the fund you're buying. The second thing is trading. So they are exchange traded, and sometimes that's confusing for investors, but really they should just think about an ETF as a fund like any other traditional fund that they've ever seen before. It is a passive fund on the whole, so it is just tracking an index, but it does trade. Now that's a benefit on the whole. So it really means that you can get in and out of the market very quickly when you need to. Most investors don't need to, because they're buying and holding it for a long time. But if the markets start to sour, they want to know that they can get out quickly. So what investors should really do is make sure that when they're looking to trade the product, because that's actually what they're doing, they're monitoring the spreads for a couple of days. So the spreads is the difference between the buy and the sell price, to make sure that they have a rough idea of where that spread is, and then they compare it back to the ASX report. So the ASX gives a report every month telling you what the average spread is, and at least you know that this is what the price I should be paying approximately is. So you don't end up buying way over the odds for the ETF because of some circumstance that's happened in the market at the time. And I guess the other key point for consideration is just when to use ETF at all. So it's not a technical consideration. This is much more about a usage consideration. So generally, and this is a very, very general rule, ETFs are very, very good for developed markets. So somewhere like America or Europe or Australia, where the market is quite developed, so there isn't that much opportunity for active managers to outperform, because the information in the market is commoditized, i.e. most people know most of the same things. ETFs are very, very good in those types of situations. Where they may not be as good is in smaller cap markets. So smaller caps where there's a lot more knowledge needed on each company. ETFs can't always achieve the same result as active managers, because ETFs are generally following very specific rules, and they don't dig deep into the company to find out which one is probably better than the other. So a general rule would be, use an ETF if you think you're going into a developed large cap index or a mid cap index. But if you're going into the emerging market small caps, so if you're going into, and I'm exaggerating, but Korea small caps, probably pick an active manager. So there's, I guess to summarize, there's a technical side, but there's also when is an ETF the right product to use, as opposed to an active manager or picking stocks yourself, and that's generally developed world large caps.
Well, I think ETFs are great products in terms of being able to get access or exposure to a full market or a portion of the market in an index or whatever. There's about 200 odd products on the Australian market now. It's been growing all the time. There's new products coming on stream all the time. So how do investors decide the difference between ETFs? Like, for instance, we've got a little bit of overlap between some of the different product issuers. What are the main things they need to consider there?
There's always, fee is one of the main things that people look at, but there's a total cost of ownership. So the concept of total cost of ownership with ETFs is a more fuller view of what costs will be. So it will be the fees, but it will also be the liquidity. So how much can someone buy without impacting the market? In Australia, most of the time, that's not really too relevant a choice, but it's something that needs to be considered. But also the buy-sell spread, that's a very big consideration, because you could have almost identical products, but one trades at 0.1% and another trades at 0.3%. And if they're exactly the same exposure, then you'd always take the one that only costs you 0.1%. That definitely needs to be considered, because sometimes that trading spread can be much more than the actual management expense ratio, the annual management expense ratio. So those types of things need to be considered, not just fee, but the total cost. And then also, depending on which product it is, we spoke in a previous session about Aussie yield. It's about the rules. So actually that takes some time for investors doing their due diligence to look through, because not every single yield dividend ETF in Australia will have different ways of selecting the stocks. Investors definitely need to have a little read and understand what's likely to be in each fund, because even though they might all say dividend on them, they've got different ways of getting different stocks in. They'll have different weightings of those stocks. So BHP might be 10% in one, it might be 2% in another. So although it's a bit of a research burden to do at the beginning, the level of understanding of just looking through, say, 6 or 7 different funds, level of understanding to be able to pick the right one for that investor at that particular time, it will only take about 20 minutes, makes a big difference.
So an investor should firstly decide what type of ETF area they want to get exposure to, then have a look at all the different ETFs covering that patch, and then do some homework in terms of what's the difference between those individual ETFs.
Yeah, exactly. And I would say that almost all the ETF providers that I know, they will help as well. So a lot of investors don't ring the different product providers. But for us, for example, we have like a small encyclopedia that tells investors for each segment what ETFs are available, what their fees are, what each fund is trying to achieve. And we make that readily available for our investor base, and presumably other product providers do as well. So I would definitely say to investors, if they're scratching their heads, they don't always need to do all the work themselves. Most providers will help investors with those choices.
And of course, all this information is publicly available. It's not hidden away anywhere. It's all available to.
It's publicly available. The only reason I mentioned the product providers is because we're specialists, so we spend time deciphering things in advance for investor requests. But yes, the whole thing with ETFs is that everything is totally transparent. All we've done is just categorized it on behalf of investors so that they don't have to wade through the information themselves.
And self-managed super funds seem to be increasingly using ETFs. I think they were pretty much the front runners in Australia, at least, in terms of using ETFs. Is that trend continuing?
Yeah, it is continuing, and it's unlikely to stop anytime soon. And the reason why is because many of the reasons that people even have SMSFs in the first place to manage their supers directly lend themselves to ETFs. So most people who have SMSFs have opted out of someone managing the money on their behalf. Now they've got a position where they need to look at how to grow earnings or sustain a living through their SMSF. And one of the key ways to do that is to reduce fees. So they can reduce fees on any of the funds that they already have in their SMSFs dramatically by using ETFs, because ETFs are considered to be one of the cheapest fund form that there is. But then outside of fees, there's also opportunity. So you mentioned yourself, there's 200 plus ETFs. Within that pool of ETFs, there's opportunities to invest in Australian yield, invest in Australian, mid caps, small caps, and then actually try and earn money outside of Australia. Diversify your portfolio by currency, but also by opportunity. So the US market is a different opportunity set to the Australian one. The European one is different from the American and the Australian. So there's a lot more opportunity to, I wouldn't say safely, but to dip part of your portfolio into a lot broader market than just the Australian one, in a way that's not going to be a big fee burden.
Yeah, and increasingly we're seeing more and more products on a global basis coming on markets as well, in the US in particular, which is the, I suppose, the birthplace of ETFs.
Yeah, so there are a lot of global ETFs, if you mean by that, ones that cover the world. There are many of them, and they serve a good purpose, because if you have like a sector, a global sector ETF, for example, some investors they invested into the US banks right after the Trump election through an ETF. So they had the ability to invest outside of Australia, but into the American exchange. But the point is more that they invested into US banks. They didn't know which bank. They didn't know whether it was JP Morgan or Wells Fargo that were going to do well. But it's just easy to get a US bank ETF that's going to go up. Same with global. Like if you have a view on, say, technology, and you think that technology is a good long-term opportunity for your portfolio, you're not going to put a lot of money into it because it could be quite volatile, but it's something that you think is going to grow way above standard equity indexes over time. So in that sense, the global ETF is a perfect opportunity or investment opportunity, because it's going to be one of the cheapest ways to get exposure to not only the sector, but the different companies within different countries across the world in one go.
Well, thanks very much, Kris, again for coming into the studio today. It's been good to talk about ETFs, what's happening. I'm Tony Kaye. I'm the editor of Eureka Report. We've been talking ETFs with Kris Walesby from ANZ ETFs. Join us again next time.